Okay, guys, if you just want the charts, as always, it's timestamped down below. You can skip right to it. But before we get started, I'd like to emphasize something to you that, last week the Bank of Japan sold $21 billion worth of U.S. Treasuries. And if you're thinking that's not much, in today's world, you're right, it isn't. But it managed to collapse the TLT by 3%. And if you need to appreciate the significance of that, they still have $1.2 trillion worth of treasuries that they can dump. And remember, the reason that they're dumping them is because they have to. Because if they don't dump them, they're going to lose their bond market because they're currently using yield curve control. And since they implemented yield curve control and the Fed didn't follow, they did the opposite. You're getting this effect where you have breakage. Okay, so the dollar is strengthening as the yen is decreasing, and these things are at odds with each other. This is what you saw in the Bank of England as well. You're seeing it in the European central banks, inevitably so, because everyone's doing the same thing. And look, this is a problem, guys. This is collapsing. There's nothing that can save this. Okay, the Fed has to pivot. They have to pivot, or it is this globally. Do you understand? That's not fear porn. This is a reality. This is a recognition of how crap works and explaining to you that we are teetering on the edge here, all right? And there's not a lot of time for these morons to address this, even though they can't make any good choices. You also have to appreciate, guys, that when the Fed pivots, and they will, that it's not a good thing. Okay, because they have, as a central bank, capitulated to the market forces that have forced them to stop doing what they said that they were going to not stop doing. Do you understand that? That's not a good thing for markets. It's a bad thing for markets. Just like if they keep raising rates, that's a bad thing too for markets because they're going to continue to break things. Do you understand that it does not matter what these morons do anymore? The breakage is baked into the cake. Okay, but it can break differently. So that's kind of the question. That's really the only catalyst left to discern is which way it breaks, but it is going to break either way. So guys, I'm trying to stress the point that time is running out in the financial markets for this Lehman moment inevitably happens. We are getting a global currency crisis that's playing out. It's a slow motion car crash happening in real time here. Okay, and you're being afforded rare opportunities to have something like what happened in Europe, to have something like what happened to the Bank of England with their pension funds and bailing that out. Okay, they were this close to a total collapse, this close. Okay, and you got to see that happen. You got to see that happen without all the contagion, without all the fallout from it. Yet, there's more to come. And have time to assess the situation for days now, week now, and be able to discern what happens next, right? You're being afforded a rare opportunity to prepare for all this stuff, especially if you're new, especially if this is all totally novel to you. You need to really be thankful for the opportunity you're being given to address what's coming, all right, and to prepare for it. So I guess the intro is just to tell you guys that more pain is on the way regardless of what happens. And if you're one of these people who thinks that the Fed pivot is somehow this good thing, then you are sorely mistaken, my friend, because markets may rally. We may get significant rallies in the markets when the Fed pivots, but appreciate that it's likely to be very short-lived as markets realize what this actually means, that inflation is not only here to stay, but it's going to get worse. We'll get into the double digits, okay? And as all of these other countries break down and the sovereign debt crisis comes to a head, okay, you're going to have complete full-on recessions around the world. And this is just going to break everything. I mean, people are going to start losing jobs in waves. I mean, things are going to get bad, okay? And, this is not going to be good for most markets. It will be good for gold and silver because that's their job. It's their job to be good in situations just like this one. And this is why I've rotated funds out of things like uranium, and I've built up cash on major wins on these swing trades, okay? Right? Because it turned out I wanted to buy uranium for the long term. I wanted to hold those positions we bought for years. But the situation changed. And when the situation changes, you have to change with it. You have to adjust. Okay? And when we recognize what was happening, we have adjusted. We have rotated a lot out of uranium into gold and silver because this is it. This is the time. And everything is singing the same song here. We're in harmony globally in the markets with what's going on. So I just want to make this intro to address a little bit of what's going on out there and to just help you with the clarion call to get ready for it, because nothing can stop the inevitable damage in this cake that's already baked. So just have that in mind. Incidentally, guys, on Monday, as the market is very oversold and it looks like it wants to bounce, though it also needs to sell off. Okay, it needs a catalyst. Okay, it needs something to make up its mind. Uh, Same thing is kind of true with gold and silver where they are, and even uranium and many things. The Fed has an expedited meeting on Monday. So it's quite curious the timing of it, as it will no doubt likely act as a catalyst one way or another, I am sure. Maybe not. These meetings are regular. They do happen on a scheduled basis, right? But the language is curious because they note that it is going to be held under expedited procedures. So we will have to see what they say. But as the markets really start to break down, you can only wonder what it will be about. I will tell you this as a point of advice. Whatever catalyst causes the markets to rally, if they do, especially substantially, a big rally, I would use that as an opportunity to reassess your portfolio and consider where you are and where you made your mistakes in your portfolio, and use that as an opportunity to get out and reposition or build cash. Okay, build cash back up for when it inevitably sells back lower. The S&P is only at 3,600 now. That is a prime opportunity for a double bottom bounce. But again, the macro is so bad that I cannot see how it could possibly break out of this W pattern to the upside. It will likely fail and break down lower. I think, again, you're looking at minimum base case targets in the S&P of 3,400 to 3,000, somewhere in there. And so until we get at least down that far, you should just anticipate that it's inevitably coming, okay? So just something to put out there for you to be on the lookout for this on Monday, because it is curious, the timing of it, as markets hang where they are now. Okay, guys, let's check out uranium. Now, of course, we're looking at the quarterly charts here, right? So that's 3 months worth of data in each candle, all right? And it's going to be opportunistic for us to do that today, because we could look at the monthly candle close as well, but the quarterly is even more valuable. And since we got the quarterly chart now with the Friday close, we're going to look at those and get a really zoomed out, big picture, years worth of forecasting kind of view here. So starting with the spot uranium price, you can see that it's got major support, which is held at about 44 bucks, okay? Now you can see the trend line is still kind of going sideways. It hasn't turned up yet, but there's nothing wrong with this chart other than the fact that the spot price itself is still running quite hot. That doesn't mean it can't get hotter, but you would prefer to see more energy down here for another leg up. You could still do it. You could still ramp up higher. You could still come up here to $73 before you end up taking a bigger break. But again, it's just is what it is. I don't see anything wrong with it. It's just kind of a chart. So in the case of URA, and this is a theme you're going to start seeing a lot, all right? So on the quarterly chart now, so you're seeing declining volumes, all right, on declining price, and you're seeing closes below major areas of resistance, okay, with long upper wicks. Does that look good to you? Doesn't look good to me. URNM, same thing, all right, major upper wick, close below key levels, declining volume, not so good. SMR, look at that candle. Look at that wick. Okay, and look where it closed, back below resistance. Okay, let's look at Cameco. Cameco is still clearly in an uptrend, and that trend is your friend until it changes. But again, it closed below where? Major resistance with a long upper wick on declining volume. Not the best look. If you were to fall, by the way, if markets really did have some kind of a just nuclear moment, right, and everything just sold down, and you wanted to try to catch the knife at the very bottom, this quarterly chart probably gives you a pretty good idea, again, of Cameco at $16. Now, this $16 level has a lot of confluence on it too. So if we were to zoom in on the monthly and weekly charts, we find a lot of horizontal resistance at $16. Also, I've done this before, historical analogs, when you measure the sell-offs in the past bull run. Okay, the largest sell-off we ever got in Cameco was 48%. you come down 48% from here and you get $16. So there's a lot of confluence at major support for Cameco at $16. So, by the time that sell-off comes, if it ever does, this trend line might be a little higher. I don't know. But if you can get a 16 handle on Cameco, whether that's 16.99 or 16.01, you should probably be a buyer. That would be an incredible opportunity if you got it. I'm not saying that's going to happen, but you always have to consider all possibilities. There are too many people in the uranium space who just think it's going up forever, and that's just you gotta chill out, dude. You gotta look at reality and understand the macro situation that's going on here. Maybe uranium does go up 200% next week, right? Maybe, but it's unlikely. The macro situation's breaking down, and what's going to sustain the move in uranium right now? I mean, it's hard to find catalysts for that in this environment. So we'll continue to monitor it on a weekly basis and see. I'm just giving you some ideas for downside potential here. And I'm telling you, if you can catch Cameco at a $16 handle, I'm a hard buyer at that, okay? And we'll go ahead and zoom in a little bit on the monthly. You can see that, again, we have confluence here. It's in the middle of these averages, all right? By the time you did sell off that far, if you did, that 200, I'm sure would catch up to 16, all right? And, again, you have a lot of support down here at these levels. This is something I'd be looking forward to. But just looking in a little bit more localized on the monthly chart, okay, it's resting at that key area, and we'll see what it does. We'll see how it shakes out. But I'm just not very impressed with uranium right now. You still can't buy it. It's okay to hold if you're one of those people who just have to be in uranium no matter what happens. But you can't be buying it right now. Remember, if you lose this trend line, you probably are coming down to $16 or something. But as long as you hold it, then you're still in an uptrend, and the long-term outlook looks quite good. Okay, so stuff like UEC, again, this is the monthly chart. It's closing below major areas of support. We'll look at the 3-month. Look at that upper wick. I mean, that just doesn't look too good. Now, you could make the argument you had one like this here too, but that was during a run-up in a completely different world. That was back in October 2021. This universe was different than this one. So you can't just look at this and say, oh, it's a sale, la, la. Nah, man, it ain't the same. It ain't the same at all. I mean, you came up to this key resistance and got denied harshly on a quarterly candle. That is not good. That does not look good. Look at NXE. Does this look like something you want to buy? Does this look like something you want to buy right now? I mean, I don't see it, guys. I mean, you've been slammed down on this quarterly candle all the way back to the floor. I mean, this is the floor. Once you lose 350 in next gen, I mean, you're coming down. Do we even have a trend? No, it's coming to the monthly. 316. How far is that down from here? 13%. It's not that bad. Let's see if you were to fall to some kind of major horizontal, something like this maybe, or this. That's pretty far. I don't know. It'd be tough to say. You'd have to zoom in a little bit more, get a little bit more localized. You'd use Cameco at 16 probably as a reference for everything else, right? That'd be your indicator. Again, we're still on the monthly. I mean, you have strong support here on this trend line on energy fuels, right? So the trend is your friend. The trend is up, and you have immediate support just below, just like next gen. So that all looks pretty good. But again, you're closing up below critical support there. Even on the quarterly chart, you're kind of rolling over. Do you have immediate overhead resistance on the quarterly? So if you were to get a major rip, let's say you did, let's say uranium takes off, let's say the broad market gets an oversold rally, uranium goes nuts. What do? Well, I think you watch something like energy fuels. Again, this is a quarterly chart, and you come anywhere close to $13 or the prior high of about $11.60, you'd probably sell, because it's probably not going to beat that. It's probably going to come up and roll back down. It'll probably sell off 30-40% from there, at least, if it does manage to come up and touch it. So that'd be a great opportunity to take profit right there. Okay, I mean, you have to think about all possibilities. You can't just be stubborn. Something like Global Atomic, again on the quarterly chart, it's having trouble breaking out. right? And you're starting to roll over. So these are not good signals. We'll just have to see. But the RSI is pretty hot even still. And so it's hard to be bullish on it, okay? It really is. So my advice is to just be patient with it and wait for something a bit better. LEU incidentally looks a little bit better than the rest. Silex, it has an eternity to fall back to support. Look how hot it is even on the quarterly chart. The last time it was this hot, it collapsed. Okay, the same thing is true on the weekly and monthly, right? I mean, it's just, you cannot buy this up here. I tried to tell you to sell way up here. I had people comment in the comments below telling me that I was nuts, and then here we are. What? How far are we down now? 30% down later. There you go. So I would totally be patient on this one. Just wait for it to touch key support, at least on the weekly. If you can come down to about 213, okay, that's the bare minimum you need to get to before you can even think about this thing. $1.80 would be a lot better, and you might get it. You never know. So continue to be patient. Uranium is not something you can buy. You can hold it if you have the stomach and the recognition that you have that much downside potential. If you're okay to hold for Cameco coming down to $16, then hold. Right? Then hold. If not, hope for a rally and try to sell out of it. But as long as the broad macro situation continues to break down, then so too likely will uranium until it bottoms out or until something else happens, a major catalyst that really accelerates it. But barring that, without that, uranium is likely to trade lower with the broad markets. Okay, guys, up next we've got gold. Again, on the quarterly chart, much more meaningful than anything else. So nice bounce off of this trend line on the quarterly. All right, you can see we've got some nice, beautiful touches here. We have always rallied in the past from touches on the quarterly chart. So it looks quite good to me. If we zoom in a bit more localized, didn't mean to zoom in that far. We'll come into the monthly. All right, so remember my base case was that we might peekaboo out of this trend line. Okay, which is when you look like you're going to break down and then you just kind of say peekaboo and you go right back, right? Well, so far that's playing out. I mean, we got back into the trend on the monthly and we're sitting right there at the 50. So there's work to do. The call is not right yet, but it's going the right way. I will tell you that historically, once you get 1, 2, 3, 4, 5, 6 red monthly candles, you very, very, very seldom get a seventh. A matter of fact, I have yet to find such a scenario. So we are due for at least a bounce. Gold looks quite good. I think that we're nailing this thing. I think we'll be vindicated on the whole thing. So again, just to reiterate in case you're new or to hammer it into your head if you're not, I think if we break down in a flush down, it only happens if there's a macro liquidity event. All right, we're talking full blown contagion, right? Risk off, everything sells. That's totally possible. I think if that does happen, you're looking at something like 1550. I'd be willing to catch the knife there personally. That's my target for the downside. Otherwise, if we don't get an environment like that, if that doesn't happen, if we don't get that sharp sell-off, then the bottom is already in. Okay, that's what I think. I feel quite strongly about it. All right, and things look quite good. We're bottoming out on all the indicators. We are extremely oversold by every metric. I mean, again, you have confluences with 2018, 2015, in line with the equities themselves. I really like what I see. But again, we have immediate overhead resistance. So next week is a big week, but the equities are already performing very well. We talked about this. I talked about buying gold and silver stocks last Friday and this Monday, and we're already up 20%. So you can see this stuff playing out, and it's going to. So I think, again, remember in terms of the y-axis, which is price, there is a little bit more downside potential, okay? But in terms of time, in terms of the x-axis and being here, I think we're fundamentally here, okay? So I wouldn't overthink this. I would just continue to accumulate. Okay, so the equities are saying the same story. We'll look at the weekly here. All right, we have some nice bullish divergences on the RSI, so that suggests we actually still have some more upside to go. And so I like seeing that. We'll come out to the quarterly chart. All right, look at this. So again, oh, and just by the way, you see this down here, how it's not lining up to anything? That's because I made it on the weekly, and since we're on the quarterly, it's just out of whack. That's all that means. but it points to the same places with the same historical references. Even on the quarterly chart, you have to go back to 2020 to be this oversold. We're actually more oversold now. And beyond that's 2015. Both times we had major ramps in price. I don't see any reason to expect anything different now, especially with the macro the way it is, especially with the fiat currencies collapsing the way they are, especially as fear, uncertainty, and doubt begin to take hold. As this war escalates and unfolds even more, everything is in place. All the confluence is there. Everything is primed and ready for gold and silver to take off. We see the same thing on GDX and giving you this golden zone to accumulate. You can see we got a nice rally right here at about 2160. All right, so that's pretty good. Again, all indications are that the sector is oversold and it wants to rally. If you come to something like AG, again, the quarterly chart, we have the same confluences in time from now to 2020 to 2018 to 2015. All times we had major ramps up. I'm telling you guys, I'm quite sure that this timeline in 2015 is what we're looking at for the next move in silver equities especially. I would expect something just like this over the next, say, 6 to 12 months for just a massive bull run in the metals. Okay, and I fully expect AG to break $24 and make all new time highs. All right, clear blue sky, it's happening. And also just look at the volume. You always get these ramp ups and ramps up in volume. Okay, you start to ramp up, boom, and then you sell off down, and then you ramp up, boom, and then you sell off down. And then what are we doing now? We're ramping up on the quarterly. This looks good. And not only are we ramping up on the quarterly, we're doing it from a massively oversold place in time. And so it's just one more element of confluence that we are well on our way. Look at Agnico Eagle. So check this out. So again, the same moments of confluence, 2018, 2020, 2015, we're sitting on a major support, all right? And look at the kind of candle that we're getting. So let me delete this to clean it up for you, okay? So look at that candle, all right? This is a nice potential. It's not quite perfectly clean of a hammer candle at all, but it does look very similar to the one we got back in 2015, okay? From there, we started a major move. And why do I say that? Well, because if you zoom in on the weekly chart, not only are we getting the same candle on the monthly, but we're getting the same pattern on the weekly, right? With the same RSI, with the same breadth, everything is the same to 2015. Everything, even the commercial positions are the same, right? The commercials in silver and gold, right? Now you're starting to see hedge funds take positions that haven't been seen since 2015. All of the historical analogs, all of the confluence, everything points back to this moment in time, and look what happened. I'm telling you, I think we're getting a repeat of 2015. Best that I can find, this is the best historical analog to where we are today. Okay, and so again, barring some kind of major liquidity, risk-off, sell-off thing, the bottom already happened. I think it's already in. Look at this ramp on this week, up 15%, and Agnico Eagle as high as 19%. Looks great. Again, we had this bullish divergence telling you that a nice ramp up was coming. And, you know, we're going to have some resistance overhead at $50. And then we'll see what happens when we get there. But, you know, everything is in place for this to play out. So I think it all looks quite good. I don't think there's any reason to overthink this, guys. And we don't have to go through all of these equities one by one because they all have confluence. If you're new to this channel, you see the same thing in every single name. Okay, so they're all telling you the same thing. And, you know, look. Gold and silver are already oversold. The charts are telling you it's a buy. All right, the macro's breaking down. Everything is in place. The stars have completely aligned to gold and silver. I don't see the problem with it. I think it's a no-brainer. I think you continue to buy, you continue to accumulate, especially if you're lucky enough to be afforded the opportunity to buy it cheaper, right? Because it's just going to V-bottom and bounce right back. I'm entirely convinced of it, and that's what I'm looking to do. And this is potentially a generational kind of opportunity as these banks continue to destroy these fiat currencies to save their debts in this debt-based system, which is as we can see, in the process of completely collapsing in real time in this slow motion car wreck. So you can prepare for it. You can do what has always been done in the past and run the safety, which is gold and silver, which always are the first to take off and the last to look back. So be confident, be bold, and just be ready because everything's pointing to a major run. Nothing has changed. Green flag, go in gold and silver. All right, I almost forgot. I wanted to include a comment left on the prior video by Coleman T. He said, I'm interested in why the Liberty Offensive avoids PSLV. Per the Sprott perspective, it's the only pure silver ETF trust that actually has vaulted silver, et cetera, et cetera. Can you explain why PSLV is not mentioned awfully as a timely option today? Well, the answer is that I've talked about it in the past, and I've got it right here for you. Here's my take on it. I think that the PSLV is a great way to get exposure to the physical metals price, okay? And PSLV will be the kind of thing that you want to own if there's ever that raid on the COMEX kind of situation, right? If there's ever a physical shortage of the metal itself. I mean, this is where PSLV is really going to shine, especially in big sell-offs when silver sells off, right? PSLV tends to sell off more, putting it at a discount to NAV. And I think that makes it a great opportunity when you get somewhere down here like it has been. I do look at it, I do chart it, and I like it a lot. Look at what we just found right there. So it's another element of confluence, just in the way it's trading, that we're approaching a low, I think, in the silver price, right? We're more oversold now than we were in 2020. Prior to that was May 19, and prior to that was 2018. But look, if you want exposure to the physical metal price or the metal itself, PSLV is great. Now, they do have a small fee, a yearly fee that you have to pay. But I think as we kind of come up into the next leg, the next uptick in the metals prices, I think PSLV would be a great way to play it. Now, it's not going to have the same kind of leverage as the miners will. It's not going to go up as much as AG, right? Unless there's ever that raid on physical. Because if that ever happens, PSLV will absolutely explode. It's going to blow people's minds, all right? But what I would recommend the physical to, the Sprott physical to, is maybe you're someone like me who probably has enough silver already, enough physical, but you still can't help but want to buy more. Well, this is a great way to get some without paying the premiums, okay? So you get access to the physical price without the extraordinary premium that the metal has right now. Because even despite that the fee that they charge on it is still less than the premium, right? Especially if you're buying a lot, right? And so that's another advantage to it too. But I actually think Sprott Physical is going to work the same way as the Physical Uranium Trust, which is that if that COMEX moment ever happens, if that raid on physical ever happens, and there's this huge crunch for physical, then the trust will come up to vote to the shareholders to allow the physical to be sold, and you'll just get a huge premium on the metals, and stuff like that will be a catalyst to major upside. I don't know if that exactly if that language exists in the physical. I have to imagine it does, because I know it does in the uranium. But that's the kind of thing you'd be looking forward to with upside in the Sprott ETF. All right, is just physical shortage, right? That's really the upside there. So that's my opinion on it. I think it's great. If you want to own it, go for it. Chart looks good. You're kind of at a bottom here. It could go a little bit lower, but in terms of time, it's going to move with the metal. So I think it looks great. Now we pretty much have to talk about the ratios here for a moment. One of my arguments, part of my thesis for getting into gold and silver so heavily right now, has been also the confluence of the ratios. And you can see that when we came down here with all the reference that we have, which even the ratios have the same confluences as the equities themselves, as the metals themselves. It's one more case to make the point. And look at what we're doing. We're attempting a rebound here. The RSI looks good. Everything is on track. We're getting a slow ramp up in volume. That is quite bullish. It appears to be that we have bottomed against energy. Same thing is true for the tech sector. Look at this massive run up. We had as much as 16% breakout against tech this week. So quite good. We have immediate overhead resistance, but we have the strength to beat it. So going the right way so far. Again, even against copper, we're making this nice sharp turn. Immediate overhead resistance. If we break that, if we can break that, close above it, test it, look, we're going straight to the 200, which is quite a far ways away. The chart looks good. Everything about the technicals look good. GDX against the Dixie. All right, so we saw the divergences here. We saw how oversold this was, even historically, with the same incidental correlations to 2020, 2018, 2015 that we've talked about so much in the past. And we are making a nice rally against this too. Again, up 12, 13% on the week against the DXY. Quite good. So the GDX against the S&P, we've been talking about it, right? We showed these bullish divergences here, all right? And against the S&P, gold is up, the GDX is up 14.5% as well, with plenty of room to run, with nothing in the chart suggesting that it is overbought. In fact, we have room to run. And so it's one more element, again, of confluence. I've been pointing this out as well. The GDX against URA, so gold versus uranium. The GDX has been oversold to URA. It was due for a rally, and we are getting that too. Again, this week, we have outperformed uranium by 20%. So it's just one more solid trade. We got out of uranium largely into gold and silver. We have now outperformed uranium by 20%. So it feels quite good, you know, and we have some overhead resistance again, which is the case broadly in all these ratios, is that we're performing well after being significantly oversold with resistance overhead. All right, so that'll be a reaction point to see what happens next. Wouldn't surprise me if we kind of test it and roll around before we go up. I don't know, but so far it's going exactly the right way. All right, and we should expect it to see it play through. If we look at gold as compared to, that's the wrong one. If we look at gold to the S&P, or actually let's inverse that. If you look at the S&P to gold, you can see that it's beginning to work its way to break down out of this bearish ascending wedge, okay? So this is one more thing we've been talking about here too, all right? And so, look, this thing breaks down, and we are not that far away. We are not that far away, just a few percent from breaking this pattern, where gold will outperform the S&P rather substantially in a massive long-term trend. Okay, so everything is going the way we expected it to. We're already starting to see the turns again, once again, with confluence of some near-term resistance only a few percentage points away. So it wouldn't surprise me to see gold or the metals or GDX kind of hit a wall for a couple of weeks or something, or a week or two, or whatever happens. But then it will retest and break down. I think that's clearly where we're going. So keep all of that in mind as part of the strategy and things to watch for. Okay, my good buddy and long-term subscriber, I think he was my first subscriber, Herman Hartner, has asked me to talk about reconnaissance energy in Africa. And so I just pulled up the chart. I haven't done anything other than what I had done in the past. So we're going to take a live look at this thing. So we're going to start on the weekly. All right. And you can see that after a major move up, we are putting in this flagging pattern. All right. This suggests that you will break up to the upside eventually. So you have a double resistance right here in the near term of about 420. I think if you can break that, you can see some clear resistance on the horizontal right about $6, call it 575 or so. But the trick is if you can break this level right here, this double confluence, right? If you can do it with volume, an upsurge in volume, then I think that the $6 level, 550 level is not going to be a problem at all. You should run clean through for a nice breakout. What I can tell you is that the bad thing about the chart is it doesn't have a lot of history, all right? It looks like it's been cooling off after a long-term run. I don't know much about the fundamentals of the company, so it's hard to do much analysis beyond the chart itself. But if we look at the quarterly chart, all right, we'll come in here and see that it was very overbought right here, all right? And it has managed to cool off quite a bit, okay? So that's actually a pretty good sign too. You know, I don't really see any issue. Let's come into the monthly. All right, so that's a good sign that you got nice support there on the monthly of about 264, 265. All right, so that might be a real good buy zone, especially how oversold it was on RSI. So if you're looking to get in or add more, I would consider again about that 265 mark, 260 mark. A further breakdown in a large market liquidity sell-off, you can try looking about, let's call it $1.86. Okay, that might be your next buy spot at the bottom of this channel. But based on what I can see, just looking at the charts themselves, is that it looks good. It looks healthy. There's nothing unusual about it. There are no negative divergences. It looks like it's trading rather cleanly with clean technicals, and I think that's always a very healthy sign. Okay, so despite the upper wick on the monthly here, you've got near-term support. You might not want to be buying now. I think your buy zones are somewhere between, again, 265 and $1.80 to $1.85. Okay guys, so what's the too long didn't watch summary of this video? Well, I think you still have green flag buys in gold and silver. I think you still have to wait in uranium. I think next week, if the broad markets are to get a rally, you should see a lot of things rally, including uranium, which is possible. But I think in the long term, as long as these things trade in confluence, you should expect more downside. I think the quarterly charts aren't the best right now for uranium. I think that everything looks quite good for gold. We still have risk of a potential contagion type liquidity sell-off in all markets, including gold and silver. But I think that these would be rather opportunistic if you've built up enough cash to take advantage should we find the opportunity to be in such a situation. Because again, as the macro breaks down, as the governments lose control of their debt problems, as they make all of the worst policy choices you can possibly imagine in unison together on a global scale, the macro will only get worse. I think that the broad markets are destined to go lower. I think gold and silver are, primed to shine here, right? They're polished and ready. And so I would continue to play the strategy as we have been going forward. I think if we do get a really big bounce in the broad markets, you should use this as an opportunity to reassess your portfolio. If you've made any mistakes, if you bought anything too early, if you're a little overweighted anything in particular, this could give you an opportunity to reassess that, trade out of it, possibly take profits, and build up cash if you don't have any for the next move down. I think that this is going to play out quite well should you get that opportunity. And I think, just be patient, never FOMO anything. There are plenty of opportunities out there. Don't get your mind stuck on a single solitary thing. I still see this problem a lot with people in uranium who just have to be in uranium and only uranium because it's Moon City. But, there are better opportunities out there right now than uranium. And so I would at least encourage you to have some diversification in your portfolio. And then once the time comes again, especially for uranium with clear buy signals, we'll buy right back in and ride the next wave up. But for now, you really have to be patient. Again, the Fed is going to have some kind of expedited scheduled meeting here on Monday the 3rd. And so we'll see what kind of catalyst that gives the markets. But either way, you need to have your seatbelts on because it's we're either rockets up or we're crashing down, falling off the roller coaster here. So just hang tight, be patient, watch everything play out slowly, and just be mentally prepared for a major change in what the world looks like over the coming years.